Hello, and welcome back to Road to Financial Freedom. Today, we're diving into the fascinating world of arbitrage. Have you ever wondered how some traders make profits without taking on much risk? Or how you can capitalize on price differences in different markets? If so, you're in the right place. In this video, we'll explore what arbitrage is, how it works, and how you can potentially profit from market inefficiencies. Before we get started, make sure to hit that subscribe button and ring the bell so you never miss out on our latest videos. If you're new here, welcome. Our channel is dedicated to helping you achieve financial freedom through insightful tips and strategies. Stick around until the end of this video because understanding arbitrage could open up new avenues for you to profit in the financial markets. Let's start with the basics. What exactly is arbitrage? In its simplest form, arbitrage is the simultaneous purchase and sale of an asset to profit from a difference in the price. It exploits the price discrepancies of identical or similar financial instruments on different markets or in different forms. For example, let's say gold is priced at $1,800 per ounce in New York, but in $820 per ounce in London. An arbitrageur would buy gold in New York and sell it in London, pocketing the $20 difference per ounce minus transaction costs. This price difference, however, usually doesn't last long as the markets adjust quickly to eliminate the discrepancy. There are several types of arbitrage, each with its own unique characteristics. Let's explore some of the most common types. Pure arbitrage. This is the classic form of arbitrage, where an investor takes advantage of price differences in different markets. For example, buying a stock on one exchange where it's undervalued and simultaneously selling it on another exchange where it's overvalued. Merger arbitrage. This involves trading the stocks of companies involved in mergers or acquisitions. For instance, when a company announces it will acquire another, the stock price of the target company usually rises. Arbitrageurs buy the target company's stock in anticipation of the deal closing. Convertible arbitrage. This strategy involves taking advantage of mispricing between a company's convertible securities and its underlying stock. Arbitrageurs typically buy the convertible bonds and sell the underlying stock. Statistical arbitrage. This type uses mathematical models to identify pricing inefficiencies and predict future price movements. It often involves high-frequency trading and complex algorithms. Currency arbitrage. This involves exploiting differences in currency exchange rates. For example, if the exchange rate for USD is different in New York and London, arbitrageurs can trade to profit from the discrepancy. Triangular arbitrage. This is a more complex form of currency arbitrage that involves three different currencies. It seeks to profit from the differences in the cross-exchange rates of the three currencies. To understand how arbitrage works, let's break it down into a simple process. Identify the price discrepancy. The first step is to identify a price discrepancy between two or more markets. This requires access to real-time market data and sophisticated analytical tools. Execute the trades. Once a price discrepancy is identified, the arbitrageur must execute the necessary trades simultaneously to lock in the profit. This often involves buying the undervalued asset in one market and selling the overvalued asset in another market. Account for transaction costs. It's crucial to factor in transaction costs such as trading fees, taxes, and other expenses. These costs can significantly impact the profitability of an arbitrage opportunity. Monitor and adjust. Market conditions can change rapidly, so it's important to continuously monitor the trades and adjust as necessary. This might involve closing positions early if the price discrepancy narrows, or adjusting trades based on new information. Let's look at some real-life examples to better understand how arbitrage works in practice. Stock market arbitrage. Imagine Company A's stock is trading at $100 on the New York Stock Exchange, NYSE, and at $101 on the London Stock Exchange, LSE. An arbitrageur buys the stock on the NYSE and simultaneously sells it on the LSE, profiting from the $1 price difference minus transaction costs. Currency arbitrage. Suppose the exchange rate for USD/EUR is 0.85 in New York and 0.86 in Tokyo. An arbitrageur exchanges USD for EUR in New York and then exchanges EUR for USD in Tokyo, profiting from the favorable exchange rates. Cryptocurrency arbitrage. Cryptocurrency markets are known for their price volatility and discrepancies across different exchanges. For example, Bitcoin might be trading at $30,000 on exchange A and $30,500 on exchange B. An arbitrageur buys Bitcoin on exchange A and sells it on exchange B to profit from the $500 price difference. While arbitrage can be profitable, it's not without risks and challenges. Here are some of the key considerations. Market risk. Market conditions can change rapidly, and the price discrepancy might close before the trades are executed, resulting in losses. Execution risk. Simultaneously executing trades on different markets can be challenging, especially if there are delays or technical issues. This risk is often higher for retail investors without access to high-frequency trading platforms. Transaction costs. High transaction costs can eat into arbitrage profits. It's important to carefully calculate these costs and ensure they don't outweigh the potential gains. Regulatory risk. Arbitrage opportunities might be restricted or prohibited by regulatory authorities. It's important to understand the regulatory environment and ensure compliance with all relevant laws and regulations. Liquidity risk. Some markets might lack sufficient liquidity to execute large trades without significantly impacting the price. This is especially relevant for smaller or less liquid markets. If you're interested in exploring arbitrage opportunities, here are some steps to get started. Educate yourself. Learn as much as you can about different types of arbitrage and how they work. There are plenty of online resources, books, and courses that can help you build a solid understanding. Use analytical tools. Invest in analytical tools and software that can help you identify price discrepancies and execute trades efficiently. Real-time market data is essential for successful arbitrage. Start small. Begin with small trades to gain experience and minimize risk. As you become more comfortable and confident, you can gradually increase your trade size. Diversify. Don't rely on a single type of arbitrage or market. Diversify your strategies and markets to spread risk and increase your chances of success. Stay informed. Markets and regulations are constantly changing. Stay informed about the latest developments and adjust your strategies accordingly. In conclusion, arbitrage is a powerful strategy for profiting from market inefficiencies. By understanding how arbitrage works and implementing it in your trading strategy, you can potentially earn profits with minimal risk. However, it's important to be aware of the risks and challenges involved and to approach arbitrage with caution and discipline. If you found this video helpful, make sure to give it a thumbs up and subscribe to Road to Financial Freedom. We've got plenty more content designed to help you navigate the complex world of finance and investing. Be sure to check out our other videos for more tips and strategies on making smart money choices. Thanks for watching, and we'll see you in the next video.